consider. We do have a handout of the presentation today. It's under the handout section of the GoToWebinar panel. And if you have any questions throughout the presentation, please list them in the questions panel of the GoToWebinar pane, as we do not monitor the chat box. And regarding questions, if we don't get to your question during this presentation, we will have Tom and Shane follow up through email after the webinar. Give them about 1 or 2 days to follow up with you if you do end up having a question. And additionally, we are offering 1 CPE credit today for attending this webinar, and to receive that credit, I just need a few items from you as the attendee. We will have 3 polling questions, just need you to partake in those. They'll be throughout the presentation today, and also please complete the survey at the end of the webinar to indicate that you do need credit. Because if you do not check the little box on there, I will not know to send it to you. I definitely want to get that out to you as soon as possible. And when prompted for the survey, there will be questions on there to let us know how we did, any additional questions that you may have, and a spot for any future topics that you would like to hear from Tom, Shane, or someone else on our team. And then if you did indicate that you did need the credit, it will come from a third-party vendor called SimpleCert. So keep an eye on that. Sometimes it drops into your junk email. And please allow a couple business days for their certificate to be sent, because it's not sent automatically at the conclusion of the webinar. And without further ado, Tom, I'm going to pass it off to you.
Okay, well, thank you, Kaylee, and good afternoon, everyone, or good morning, depending upon where you're joining us from today. We appreciate you taking some time out of your day today to join us for this topic, construction, state, and local tax compliance. Some of you may or may not have been with us. About 2 weeks ago, Shane and I did a similar webinar directed to the architecture and engineering group, and some of our material today will be similar, or maybe even the same information, because it's applicable to both industries, but there certainly are some things that are unique to the construction industry, and we're really going to kind of hone in on that as well, and Shane's going to have some examples for you on that of kind of the complexities that we're getting into here, and that's maybe the theme of the day. Here at Stanbaugh Nest, we have a initiative going on. We call it our Anticipatory Organization Initiative, and it's really a study group we have that's trying to say, how can we better look down the road at what we're going to be confronting as a firm, and what are our clients going to be confronting. And one of the lessons we learn in that, the future is predictable in some manner if you follow what we call hard trends. And there's 3 primary hard trends that we have identified, and they fit very well on this topic of state and local taxes. One of those trends is demographics. I'm not sure this one has quite as much applicability, but we all know that the baby boomers are aging, and there's going to be a lot of succession coming up, and transition in all of our firms. And actually, when we get to the very end, we'll even tie that trend in, because we do think that has some applicability to state and local taxes. But the other 2 certainly do. We're seeing a much, much more aggressive reach from regulatory agencies. That could be departments of revenue, that could be other taxing authorities, it could be permitting, it could be whatever. But everybody is looking at their budgets, everybody is looking to generate revenue wherever they can, and the states are certainly no exception to that. And that's where the third hard trend ties in, and that's certainly technology, and we all are facing that within our own companies. New ways, better ways, complicated ways we may not understand to do things. But guess what? The states and the localities are using the technology as well. They're sharing information between departments. So, you know, that old adage of, I'll let the state catch me and then I'll get on board, we certainly don't recommend that anymore, because we think, unfortunately, they will catch you. So you may hear the theme of the day is the aggressiveness of the states. I will apologize in advance if maybe some of our message has a negative slant to it, but you certainly need to be aware of this. And I think if you're proactive, we can maybe turn that negativity around into getting you the best bang for the buck, and doing some planning to try to address what's coming down the pike. So with that, we have on the screen now just a few of the topics that we'll be getting into. Shane is certainly going to be unpacking these one by one, and we'll hit on each and every one of these. But before we go too much further, we did want to get an idea of who our audience is here today, and that brings us to our first polling question. As Kaylee had referenced, we do need you to answer the polling questions so that you can get your CPE, but it also helps us with our comments today. And this is a pretty simple one. We're just interested in how many states your company files corporate income tax returns. A couple of choices there: 1, 2 to 3, 5 to 7, or more than 7. So we'll give you a second to answer that, and Kaylee will let us know when we have a sufficient response.
Well, Tom, good news. Everybody is awake this afternoon, so I'm going to go ahead and close and share the results. So it looks like 21% say 1, 38 is 2 to 3, 10% is 5 to 7, and we actually have 31% of the audience that have more than 7 income tax returns that they file. Wow,
that's quite a varied response there. So we have a little bit of everything in the room, and we're going to be talking. Certainly, we don't want to heap the responsibility for more states on your plate, especially if you're in that more than 7 category. But we certainly do want to bring awareness to you of what the trends are and point out, or at least make you think about, do you have some responsibility in other states? So to do that, we'll just start with, I'm going to ask Shane to kind of walk us through some overall observations of what we're seeing as far as trends, and then we'll get into it by a little bit more detail. So Shane, it's all yours.
Thanks, Tom, for setting the stage very nicely. And I guess I'd just like to kick this off with, half our battle here is just simply educating our clients, educating our prospects, educating our fellow CPAs at other firms, and also educating our internal CPAs here that the landscape has changed dramatically just in the last 5 years alone. As Tom noted, a lot of it is on the state government agencies are becoming more aggressive. They're becoming more aggressive, but it's also because they've invested in technology. Technology is the #1 driver in finding quality out-of-state audit targets. The last thing they want to do is upset a homegrown, physically located taxpayer in their state. So what better way to drive revenue is find the out-of-state businesses. Being a construction company, you could have a license just to operate in that state. They can start to connect the dots. Well, they have a license, but they've never filed an income tax or a sales tax return, and it's only a matter of time to get a letter in the mail, typically in form of a business questionnaire. Nexus questionnaire is the lingo. But I guess the entire reason we're here is to obviously talk about these issues that were listed on the agenda, as well as here, the first slide, the overview on multi-state taxation and the trends that we're seeing catered specifically to construction companies. Tom and I thought these were the most applicable. But again, this is an education process. So I would say half of the content here is more going to be us educating and sharing with what we're seeing in the market. So I guess with that said, here are the things that we think are most important over the last year or so. And I think the biggest message today is that changes are constant. They're definitely not slowing down anytime soon in the foreseeable future. We'll touch on the different Supreme Court cases and changes to the different states' procedures, new bills, more legislation, added taxes. They're definitely not slowing down anytime soon. If anything, they're turning the volume up here on finding ways to tax out-of-state businesses. There's really no way around it. We just want to educate you and arm you with the knowledge and get out in front of some of these items. And I guess just the final note, since we do have such a varied response on how many states that your company files corporate income tax returns, so when I see the 1, then it's, should we maybe be filing in 1 or 2 more? That's my first, gut on that response. Now the 2 to 3, the 5 to 7, the more than 7, in my opinion, you probably have down where you should be filing for income taxes. Now I start thinking outside of income taxes. Are you in a state that imposes a gross receipts or a franchise tax? Are you looking into your sales tax issues? We're going to spend a lot of time at the end of the webinar today on drilling down on sales tax compliance for construction contractors. But that's where my initial reaction is for our responses here today. So here's the overview of the trends. We're going to touch on everything at some point during this webinar, but I guess the message for this slide is no state has the same rules. Generally, they are similar, but know that there are intricacies for each state, and you definitely need to look at them as you expand your construction business before you even put a bid on that new job. The South Dakota versus Wayfair U.S. Supreme Court case, definitely a big driver of this. We'll touch on that in detail soon to come. And I guess just the final note that I think is super important is sales taxes for construction companies. It's no longer something that can be overlooked. I can tell you right now, I spend more of my day answering sales tax related questions than income tax related questions, which 5 years ago, that would be hard to believe if you told me that, but that's just the environment that we're in. So, Tom, if you have anything else to add on the trends?
I would just reiterate some of those things that you said there, Shane. My takeaways are very similar to yours, that certainly technology has been a huge game changer. The states are investing in it. They are doing some cross-checking. So they are certainly anxious to find out about you, especially if you are that out-of-state company. You're coming in, you're doing a project within their state. They want their piece of the tax on that, whatever type of tax that would be. And you certainly, if you're not reporting it, you're very likely to be a target for that. And I think you said it, Shane, that sales tax has taken on a whole new life here. I've been in this business a long time, and I've focused most of my time on that income tax or franchise tax side. And it's really this South Dakota versus Wayfair Supreme Court decision that went down in 2018 that's really accelerated. I think sales tax was coming before that, but Wayfair really accelerated. And you might be sitting there saying, Wayfair, aren't they those guys that sell furniture online? What does that have to do with me as a construction company, and why has that impacted my operation? So Shane's going to walk us through that. He's going to relate that to us. But I think it's first, Shane, before we even get into the detail of how this relates to construction, I think it's important for the folks to understand Wayfair, what it's all about, and actually what it replaced.
It's a great point, Tom. I understand our audience here, they're construction companies. So give us your ear for a second. As you know, this webinar is education first, so the trends we're seeing in state and local taxation. And there isn't a bigger trend that's happened in the last 25 years as of the previous U.S. Supreme Court case was 1992 in North Dakota. So that was the law of the land that was just overturned last summer. So in a nutshell, what this case was is it redefined what was considered physical presence nexus. So for a construction contractor, that would be having an office, having a job site where you're sending employees, or hiring a third-party subcontractor to perform the services on your behalf. You have inventory located in that state. Things of that nature, which is physical presence, what we've all been operating under since 1992. Well, that was all overturned here, and now physical presence can simply be defined as $100,000 in sales revenue. So as a construction contractor, how can that impact you? Well, certainly if you have an equipment division or something of that nature where you're selling online and you've never been to that state, this would definitely be something that would impact you, as it's high dollar sales and it's a very low dollar threshold to create physical presence. But what this did for the rest of the country and the trickle down effect it had upon state corporate income tax, which we'll touch on in a few slides, again, it's redefining how we've been doing business and filing taxes. This is a U.S. Supreme Court case, and the fact that state tax has been on the docket, and there's probably another one coming on the corporate income tax side. But at the end of the day, they took physical presence, meaning you had to be there, to simply just numerical threshold. $100,000 seemed to be the magic number, and then lo and behold, every single state rewrote their rules to mirror South Dakota's. So again, once the precedent's set, it's really the domino effect, and we're seeing that spill over to income taxes as well. So here on the second slide for Wayfair, it's just to explain the definition of what physical presence was, and as you can see, these have been the law of the land for 25 years, but not so much anymore. And I just wanted to highlight, it's simply just the economy is completely different. It's transitioning from the brick and mortar business to an e-commerce driven economy, and the state's missed out on billions of dollars of sales and use tax revenue, and there's no way to dispute that. So they're trying to play catch up, and this is just something that we'll continue to see evolve as the years go by.
So Shane, if I am a contractor and I determine I do have presence in another state, maybe I had it before July 2018 for many of those bullet points that are listed there, or now I have it because of this economic nexus threshold, which makes it a lot easier for the state to claim that. From a sales tax standpoint, what are the kind of things I should be doing as a company?
That's a great point, and it's something I often hear when I get a client or prospect or a friend of the firm give me a call to try to help a construction company, and they hear about this Wayfair, the Supreme Court case that kind of took the tax world, the accounting world by storm last year. And more often than not, I end up finding problems that they've had in the past just off the old-fashioned way of physical presence. And you had Nexus, but you failed to file a return for whatever reason. Maybe you didn't realize a sub acting on your behalf created a filing obligation. Whatever the reason was, there are ways to get into compliance, and that's through voluntary disclosure programs. We'll touch on that later in the webinar as well, but that's again a proactive tax planning strategy that if you do have a couple skeletons in the closet for 10 years or so, these are fantastic taxpayer-friendly programs where you can limit your look back to typically 3 years and full penalty abatements. So it's a really fantastic way to get into compliance, especially if you're looking to sell your company. So that's something else we'll touch on later, but that's when these become mandatory versus just a recommendation.
Okay, thanks, Shane. Now that we've touched on sales tax here, we're going to circle back to, we're kind of going to do this webinar in kind of a circular fashion. We're introducing the Wayfair concept here, and then we're going to transition over into the other types of taxes, income taxes, franchise, grocery receipts. But then we're going to come back to sales tax in the end because we think that kind of ties it all together. But before we do that, we are going to launch a second polling question, and it looks very similar to the first one we asked you. The only thing we've changed now is not how many income tax returns that you file by state, but how many sales tax returns. And we're kind of really interested to see if those results look similar to the income tax. I mean, my gut is that they probably should, or maybe even a little bit more filing at the sales tax level. But let's see how the audience responds to this one.
All right, I'm going to go ahead and close that down and share out the results for everyone. So 34% only file 1, 21% file 2 to 3, 10% file 5 to 7, and 34% file more than 7.
Well, interesting. Those results are very, very similar to what we had in the income tax. So it sounds like we have an educated group here with us today, and that's great to hear. Sometimes when we get around in our circles, that's not the case, that people were kind of surprised to hear some of this news we have for them. But that's great. It sounds like people are doing their best to be in compliance, and if we can give you a few more tidbits today to help you out on that, and hopefully, to be proactive, that's certainly our goal. So as I said, we're going to move next into some items that are more kind of structured towards the income tax reporting. And the first one of those is something called mandatory combined reporting. As you'll see in the theme of a number of our topics here, a lot of these, again, are centered around how can we get the out-of-state company to report more revenue in our state and enhance our revenue recognition or tax revenue here in this state from those guys that are coming in from out of state to do projects. So Shane, if you would, give us a little bit of an overview of what mandatory combined reporting is all about and the trends you're seeing there.
So this reporting trend really is a driver, and it's just going to continue to level the playing field for corporations and pass-through entities. And it boils down to it really removes the state tax planning opportunities that we can do for these companies, because it just simply treats everybody as one big happy family, one big taxpayer, versus before we were able to treat them as different entities. And this trend definitely impacts C corps. So for the S corps on the phone, this really isn't as impactful, but we try to blend in tax planning and trends for both C's and S's. But this has been actually going on for a long time, this trend. So if you have a unitary or a consolidated group of corporations, for state tax purposes, it's similar if you file one return on the federal level. But at the state level, instead of filing each separate entity in a state, now you just file one simple return for the entire consolidated or unitary group. There's definitely a long list of states that require these combined reportings, and that list will only grow, and that's something that we'll harp on these next few trends. They're all headed in one direction, and it's not slowing down anytime soon. Like I said, this is to really level the playing field, because it simply takes the ability for us to proactively plan. And the states are viewing these self-related entities as simply one taxpayer, as they are acting together with a common purpose. So I definitely see this as another trend where the list of states that you'll see on the map, the next slide, I would anticipate to see more of the gold color as the years go by.
Yeah, I think you make a great point, Shane. Again, I hate to say how many years I've been in the tax game, but certainly the norm in the past was when you came to state reporting, if you had multiple entities, each of those entities filed individually in each of the different states. And by doing so, it gave you some nice opportunities to maybe be able to shift taxable income and shift profits to lower tax states. Well, I think they're figuring that out. Making you file all as one doesn't give you quite that same opportunity. And you can see, a good bit of that map has gone to mandatory reporting, and you can see there's some very populated states such as California, Texas, New Jersey, Illinois have already gone there. I know it's been talked about many times in Pennsylvania. You still have New York and Florida out there as fairly populous states that haven't gone to it, but it's picking up steam, and I think this will continue to be the norm as we go forward. And as Shane said, unfortunately, it does take some planning opportunities away, and it gives everybody, all the states, a little bit of a piece of the pie on that. Another trend I think that we're seeing is gross receipts taxes picking up steam. States putting gross receipts taxes in place rather than an income tax, because that certainly has, again, some benefits to the state in how they, in how they tax an out-of-state company. Typically, gross receipts tax, I think, Shane, has a little bit broader application. And I'm thinking about, Public Law 86-272 and how it applies to income tax and how it does not apply to gross receipts tax. And everybody in the audience is probably saying, what are you talking about? What's Public Law 86-272? And maybe if you just want to touch on that briefly and then talk about how gross receipts tax is the way the states avoid that.
Yeah, this is a great time to get that out of the way, and also an excellent point that you may have the protection on Public Law 272 for state corporate income taxes, but not for gross receipt taxes. So what Public Law 272 is the law of the land for state corporate income tax, which allows out of state salespeople to solicit tangible personal property sales. However, if you are soliciting sales of services, then you lose protection under Public Law 272, and therefore then you need to pay your state corporate income tax on the sales derived from those states. Now, to your point, Tom, even if you have protection under Public Law 272, because you have an employee, a salesperson that's soliciting sales of tangible personal property, let's say it's in Texas, where they have a gross receipts tax, you would not have to pay Texas equivalent of corporate income tax, but you would be subject to the gross receipts taxes. And gross receipts taxes were few and far between in the past. However, Ohio was the one that was the real groundbreaker that replaced their equivalent of the state corporate income tax with a commercial activity tax, or short CAT, the CAT tax. So that was a groundbreaker in 2010. Other states with gross receipts taxes that you may want to keep your eyes and ears open for are Delaware, Nevada, Ohio, Texas, and Washington. But like I have on the bullet point, many states also have proposals in right now. So 7 other states are trying to get gross receipts tax enacted in their state. And contrary to what Tom said at the beginning, sometimes they don't replace the income tax with the gross receipts taxes. Some states pile on the gross receipts tax on top of their income tax. So that, again, just leads to more tax revenue for the states. Just be aware of when you're in a state if these gross receipts taxes apply. In a nutshell, it's always been, when we go to educational opportunities, are gross receipts taxes helpful or harmful to the taxpayer? The helpful side, the positive side of the argument is gross receipts taxes are always a low rate, very easy for taxpayers to prepare and file. Typically, when they're replacing the archaic, hard to file, hard to figure out state corporate income taxes of the past. Now there are some drawbacks. So I would say the negatives are that if you're in a loss position, you're still going to owe the gross receipts taxes on your sales. Definitely very hurtful to startup companies, or if you're in a cyclical type industry. If you're in a high volume, low margin business, not helpful to you either. So an example that happened this year, which, I'm not going to spend too much time on, but the Oregon has just enacted their equivalent of the commercial activity tax called the corporate activity tax. Pretty standard type thresholds exceeding $750,000 in sales, $250 minimum tax, excess of $1 million. Just to highlight here as well, sometimes they don't replace the income tax with a gross receipts tax. Here's an example just this year that they just piled this gross receipts tax on top of the state income tax in Oregon. So not happy taxpayers in Oregon, that's for sure.
Yeah, great points, Shane. And you make a great point there that I think I did maybe mislead a little bit there at the beginning that, in Ohio, it is just a commercial activity tax. There isn't a corporate income tax, but some states do have both. So as you said, that's a little bit of piling on. And for our construction friends out there, Public Law 86-272 may or may not help them. If you're actually physically doing a construction project in a state, 86-272 is probably not going to help you. You already have a physical presence in that state. But for some of the other activities you have where you may just be, as you gave some examples earlier of equipment leasing or things like that, wouldn't have risen to the level of an income tax. You may get called up in the gross receipts tax. And I think your other point is a really good one, that you're going to pay this tax if you have activity there, whether you're profitable on it or not. So while it may be a lesser rate and a lesser amount, you're not going to get that break on the year that you didn't do quite so well. You're going to pay this tax year in over year in. So you can kind of see maybe why it's picking up some steam and some popularity with the states. It's kind of a guaranteed revenue stream for them. Another trend, and this is continued similar theme. How can we get more money out of state entities that are doing projects in our state? A lot of states are going to what we call a single sales factor apportionment. Again, that's a mouthful, sounds pretty technical. We're going to explain what that is, and we're also going to contrast, or maybe we're going to begin by contrasting that to what we used to have, which was something called the three-factor apportionment, and why a movement from three-factor to a single factor puts more tax revenue in the out-of-state tax department.
So a driver here for the single sales factor apportionment and the trend that's overtaking the old three-factor apportionment is it's a business development incentive by the states to attract businesses in-state, just simply because they're eliminating the tax cost of physical relocation. So for a long time, in order to calculate your state apportionment, it was a three-factor based on property, payroll, and sales into the state. So very straightforward to calculate each state's piece of the pie, so to say, was just a percentage of the property, payroll, and sales. Each factor was equally weighted, and this was the method for a very long time. Now the trend is simply to weigh the sales factor heavy on either two, and now to just a single factor for your percentage of income to the state. Makes it even easier. Simply sales by state divided by sales everywhere, and that's how you get your apportionment of income to your specific state on the single sales factor apportionment. Sorry, that is a mouthful. So again, this is another way to attract businesses to stay in state, and another way to drive revenue to the out-of-state foreign businesses coming in. This is so using single sales factor, and also if you couple it with market-based sourcing, which we're not touching too much on today, but that can be an added benefit on the apportionment formula.
So yeah, we've got a map for you here as well, and again, you can see in the darker colored blue states, so those states have gone to single factor apportionment. Again, it's maybe a little less than half the total states, but look who they are. Again, the heavy populous, the heavy tax states: New York, Pennsylvania, Massachusetts, New Jersey, Texas, Illinois, California. So if you're doing business in those states and you don't reside in those states, they're now getting a bigger piece of the pie. Think about it. When it was a three-factor apportionment, your property factor and your payroll factor was probably zero in those states, and you put your sales in there. Now taking those factors out, you've been typically tripled your apportionment factor, and that drives that out-of-state tax burden up. So, again, though, remember, when you do state tax planning, it always seems like a negative, and you go, oh, wow, I got to file in another state, or I got to file in multiple states. Remember, though, sometimes that's a planning opportunity. What are the rules in that state? What is the state's tax rate? How can we gain an advantage, maybe even by shifting some of our operations into those states? And we're not going to get into it in this webinar today, but certainly while those states certainly love to tax you as the out-of-state entity, they also are very apt to give you some benefits, credits, incentives, and whatnot, if you will bring your bricks and mortar and your payroll into their state. So, yeah, I think what we're really just trying to emphasize here is the trend that if you've only been filing in your home state or in the states very close by and you are expanding, you certainly need to give this a little bit of attention. So we promised we would kind of circle back into sales tax, and this is kind of the beginning of this. We're now going to combine, what did we learn from Wayfair? First into the income tax world, because we think there's going to be a bit of a trend there, and actually we've already started to see the ball rolling in that trend. So what are the states trying to take advantage of from a Supreme Court case that was really directed only to sales tax, but that may not be for long.
Yeah, this has been a busy year for CPAs and tax attorneys to keep up with all the different state changes since Wayfair. Certainly on the sales tax side, as it was a sales tax case, but like we stated at the beginning of the webinar, there was absolutely a trickle-down effect into the corporate income tax world. So for companies that can claim an exclusion for income tax under Public Law 86272, right now that's still the law of the land. Federal law trumps state law and protects them. Interesting developments have already happened. So for example, one change, and the one who set precedent is Hawaii. They're the first state to actually enact a sales or transaction threshold, very similar to the South Dakota's rules, which is $100,000 of sales, gross sales. And whether it's a coincidence or not, Hawaii uses the same exact rules and thresholds for them, and they've actually enacted it. And now you have the same rule set to apply for their state corporate income tax. So if you have $100,000 of sales into the state of Hawaii, now you have to file not only a sales tax return, but also an income tax return. Which leads to our final bullet here, which is pretty comical. I actually drafted this presentation about a week ago, and since I drafted it, Pennsylvania, our home state of Pennsylvania here, actually has done something similar, not quite as low of a threshold as Hawaii, mirroring the South Dakota 100,000, but Pennsylvania has a $500,000 sales threshold, which will then require you to pay Pennsylvania state corporate income tax. So I guess just to show how quickly things can change, a week and a half ago, I prepped these slides, prepared the webinar, and between then and now, Pennsylvania enacted a similar rule. So right now we have two states. I would keep attention to the news, because I guarantee you, if we do this an update a year from now, there'll be plenty more states to add to this list.
And Shane, one thing I noted I thought was interesting what Pennsylvania put out, and it's obviously still very preliminary, so the smoke hasn't cleared on it yet, but Pennsylvania is going to require reporting even if the transactions are not taxable to Pennsylvania. If you do have protection under Public Law 86272, they're still going to force you to file a return in Pennsylvania, let them know the dollar volume of your revenue in the state and the fact that you're claiming relief under 86272. So there's certainly a gathering of information, if nothing else. And, when Shane introduced Wayfair earlier in the webinar, he talked about it replacing a prior Supreme Court case, the Quill case versus North Dakota, which dated the whole way back to 1992. So certainly in 27 years, or I guess 26 years, until Wayfair was enacted last year, our economy has changed significantly from a bricks and mortar to an online economy. Well, think about Public Law 86272. That's been with us since 1959. So as Shane said, it's still a federal law. It's the law of the land. But you can see the states are already starting to push some buttons here and push the issue. And I would not be surprised if it continues to get challenges and just may crumble here as we move forward, just as the prior sales tax cases did. So now we're going to fully jump back in. Hopefully you've got a you got an understanding now between the relationship between both sales tax, income tax, the other taxes, the attitude or atmosphere that we're working in with the states of being aggressive with this. So as sales tax takes a more prominent role, especially here for construction firms, we'd like to talk a little bit about how we can plan for that. So to kind of get a feel for that, we're going to get into our final polling question of the day. And just, it's a simple yes or no question. Whether your firm has had, at any point in time, hopefully recently, but at any point in time, a sales tax compliance review. Do you have a good feel that you are in compliance? So Kaylee will accumulate those results, and when we get an adequate response, we'll share that with you.
Alrighty, so we have 57% say yes and 43% say no to your polling question, Tom.
Okay, well, good. As with the other polling questions, we're pleased with those results. Like I said, it sounds like we have a very proactive audience with us here today. But with that being said, we're going to talk about some ways that you can plan for sales tax. Shane's going to walk you through some of these examples here, and then I think what you'll find very valuable is he has a case study. He's going to walk us through a real life case study, I believe, something you've experienced and the kind of, I think, complexity that you can jump into. So, Shane?
Yeah, so we're going to close strong here on state sales tax planning for contractors, and I was fortunate enough throughout my career to work with some very large multi-state construction contractors, and I do some sort of work for a contractor every single day. So it's something that I'm just going to share my playbook with everybody here on the webinar, and just really begins with getting a feel for your company. Where are your offices? Where are your projects? It's very straightforward. Here's the states we need to worry about for sales taxes. Do we have inventory anywhere? Are we selling anything online? Are we doing anything of that nature? Getting a full understanding of where you have nexus, which is a fancy word of saying, where did you create a state income or state sales tax filing obligation? Since we're on sales tax planning, we'll just focus strictly on the sales tax. So the first thing that you need to understand is that services generally are not subject to sales tax in any state. Each state has a specific enumerated list of what they tax. So first things first, you need to have a list of every service that you render at your construction company. If you're simply building a house or building a corporate location from start to finish, you're really not going to have as much complication with any kind of sales tax compliance. The more services that you render, the more states that you're in, it has even more importance on understanding what services are taxable in each state. You really have to break out. You need to make some sort of taxability matrix or something an internal document for you to understand, in the half dozen states that you're operating in, here's all the services we provide, and you need to know if that's taxable in that state or exempt in that state. It's not universal. Each state does have their own unique set of rules, and nothing is more true in what states impose sales tax upon their services. There really is no rhyme or reason, typically tied up in the political landscape. But when you're a construction contractor, the nuances are something you need to pay attention to. You need to make sure that you itemize them or enumerate them in your contracts and your sales invoices. Because if you do have something taxable in there, and it can actually create a bundle transaction, and therefore subject the entire transaction to sales tax, even if just a portion, 10, 20% is subject to tax. Again, a list of, let's rattle off a few services that, these are problematic. Any kind of installation, really need to know the rules. Repair services, inspection services, preventative or scheduled maintenance, and safety oversight, implementations, things of that nature. So just make sure that you have a grasp on other services that you render aside from what you would consider a construction service. And I would say the next thing that you need to understand is, am I paying sales tax or use tax on the materials I'm purchasing? And I strongly recommend having some sort of centralized or even a separate entity to purchase the materials for you. If you're a multi-state contractor on the phone, you understand the headache of purchasing from an in-state vendor or an out-of-state vendor and trying to have them charge you sales tax to where your destination is, where your project's located. So I always really stress, do not rely on your vendor to do anything. I recommend, if you don't set up a separate entity, that's best case scenario, but make it centralized. You have one purchaser at your company. Give your vendors exemption forms and accrue the state and local use tax on the materials that you're purchasing to where the state and the city is that you'll be doing your construction project. A lot of times we see contractors that they like to do business with their friends. Typically they're in their home states, so they buy all their material paying the state sales tax and the local sales taxes where they're located. But let's say you do 40% of your projects outside of your home state. Worst case scenario, let's say those states that you're going to do these construction projects with these materials that you paid tax on to your home state don't have sales tax reciprocity. So now you're upside down in the worst case scenario. You erroneously paid the 6 to 10% sales tax on the material, and now you have a sales tax liability of 6 to 10% to the state that you're installing these materials. So you can get yourself in a pickle there, and it happens more often than you think if you're not paying attention to these type of sales tax planning opportunities. So again, that's something I stress strongly. Make sure you're making your own decisions and not letting the vendor themselves make that decision for you. Just want to touch on a couple more things here, unless Tom, you want to interject?
Well, I don't want to put you on the spot, Shane, but as you were talking about that, about centralizing your purchasing and making sure you're paying sales tax where the material is going and whatnot, I've heard you talk about another concept, and I apologize that I didn't warn you I was going to ask you this question. But if these firms have a fleet of vehicles, of trucks and whatnot, I think I've heard you talk before about some good planning opportunities there as well. Does that make sense to do something with your fleet?
Yeah, this is an added bonus for our listeners. I didn't actually incorporate this into the webinar, but it's absolutely an excellent state tax planning and also just a liability planning opportunity that if you do have company-owned vehicles and you don't have it broken out into a separate transportation entity or whatever you want to call it, that simply houses the trucks that are carrying all of your equipment and material to these job sites. Sometimes people overlook the fact that even though if it's a related entity, as long as it's hauling the related entity's goods for a fee, that qualifies for transportation entities. So the benefits on that, which is what you're driving at, Tom, is the liability is removed from the construction entity. And it's held in the trucking entity on its own, but you can also purchase any new fleet exempt from your state sales tax. So if you're investing $1 million in a new fleet of trucks, new fleet of vehicles, you're able to save the $60,000 to $100,000 of sales tax on the front end purchase. You also, the repairs to the trucks are exempt from sales tax for the lifetime. And the final tax benefit is the lease itself is also exempt. So the construction company leasing that vehicle to ship the equipment and material to the job site would not be subject to sales tax, which it typically is. So if you're on the phone now and you do have a current fleet, you can still transfer them to save the liability and to save sales tax on the lifetime of the repairs on the trucks and also on the lease. So even though you're not you don't have plans to buy a new fleet, you can still make that transfer for some savings moving forward. Sometimes the straw that breaks the camel's back is when a construction company is planning to purchase new vehicles. So that's even more an incentive to do so. But excellent idea, and see a lot of construction companies that are not taking that excellent tax planning strategy. So great point.
Yeah.
I still have a couple more things I want to touch on here. And as a construction contractor, you really need to understand your contract types. And I'm sure you've at some point ran into a state where you're unsure if what you're doing qualifies as a construction contract. Am I installing tangible personal property into real property, which is constituting a construction contract, or am I installing tangible personal property that never becomes real property? You really need to understand the rules for each state you're doing work in. The states all vary dramatically, and if you don't understand the rules, you're going to be doing it the opposite way. They have an inverse impact on what you're supposed to do. Some of the harsher states, such as New York and New Jersey, you actually need to meet a three-pronged test to be considered capital improvement, which falls under, is it new construction? Is it improving the useful life of the building? Is it adding value to the building itself? So if you don't meet that three-pronged test, then you're going to be considered an installation of tangible property. So you definitely want to understand these rules everywhere you're going. So if you're executing a construction contract, you pay sales or accrue use tax on the material. You charge your customer without noting sales tax on the invoice, but you pass it along in a hidden manner, however you do so, to recoup the tax. If what you're doing is not qualifying as a construction contract, then you purchase the material exempt using the resale exemption, or a little footnote, if you're the manufacturer of the material and the contractor, then you just don't have that obligation to accrue use tax on the material. And then you actually charge sales tax on the entire invoice, so it would be on the material and the installation and the services. So as you can see, it's the exact opposite. So you really need to understand what's your list of construction services. If you're 100% certain that it's qualifying construction in every state you do business in, I would at least double check it. If you're starting to do other type of services outside of the realm of the traditional construction, then you definitely need to look at this on a case-by-case basis. I'm entering this state. What are the rules on these services and installations that I'm doing? There's nothing wrong with doing two different types, a capital improvement and not. You just need to understand when to charge tax, when not to, when to pay tax, when not to. I guess just to touch on a couple other things, the exemptions, I really understand that not everyone's exempt. Sometimes I see contractors taking an aggressive stance that they're doing work for a nonprofit, they're doing work for a government entity, automatically assume everything they purchase is exempt from sales tax. If you're doing an installation or a repair, they think, no, they're exempt, everything's tax exempt. Couldn't be further from the truth. So know the state rules when you're entering, and make sure you get an exemption certificate from your customer stating so. For example, PA has a really funky exemption for nonprofits and government entities. Only certain equipment, the building, machinery, and equipment under Act 45 actually qualify. So just don't assume everything is exempt. Make sure you do your homework. And it flows into our final planning point here is know these answers before you bid, because you need to know the right amount to add of the sales tax into your material, or is it on the entire amount of your sale? The last thing you want to do is have to take that out of your margin. So the bigger the job, the more important it is to review prior to you even make the bid. So running out of time here,
yeah,
5 minutes in the case study.
That's a lot of great information, Shane, and and I think you have a really great case study here to share with us to kind of put a bow on all this and wrap it up. So take us through that.
Yeah, this was a client that worked with for many, many years, and they really haven't had an in-depth state and local tax planning compliance on the front end, on the back end, et cetera. So a lot of damage was already done. and they were based out of Pennsylvania, but it doesn't really make a difference. I'm just using PA, New York, and New Jersey as examples, but any construction contractor operating in multi-states, it's the same concerns. So go back to the example that I laid out initially. They were purchasing all their material locally. They were doing about a third of their business in each state. So the 2/3 of the material is being shipped out to New York and New Jersey, which they don't have sales tax reciprocity with in any state. So they were overpaying the 6% on all the materials that were going out. And then they were underpaying, so they had a liability in New York and New Jersey on the materials, on the sales and or use taxes, because they didn't pay any tax to those states on the material they were installing. So again, worst case scenario. Not to mention the rules are complex in New York and New Jersey. So some of the construction services they were rendering were qualifying as capital improvements, but some were not. Of course, they were treating everything as construction contracts. So again, they had a liability on some of those sales that they weren't charging tax on the construction services. And then they also had an overpayment on the material, because if it wasn't becoming part of real property, they should be buying that material for resale. So they were really upside down and backwards on pretty much everything outside of their home states. There's, also with the state corporate income taxes, you need to make sure you're paying the right tax to New York and New Jersey, not just everything to Pennsylvania, which is what they were doing as well. These jobs were very long jobs. They were there for a year plus. So there was also employment tax that we needed to worry about, which they were not up to speed on, the New York and New Jersey employment taxes. So in a nutshell, everything we had to do to get them in compliance, there's a Pennsylvania sales tax refund on all of the material purchase that was shipped outside of PA. We were able to obtain the refund, which can help offset the New York and New Jersey state sales taxes or use taxes on the material used to be installed on these projects, and also some of the gross receipts taxes. However, filing a refund in PA triggers an audit, which then we had to deal with the sales and use tax audit defense, which if anyone's been on the receiving end of them, time consuming, it's exhausting. And then also the same things we had to do in New Jersey, we did in New York. So we had voluntary disclosures for sales taxes and use taxes that we owed, for employment taxes, and also for corporate net income taxes. So as you can see, it was a long couple-year process to get them in compliance. It was time-consuming. It was a difficult time to go through with the contractor, but at the end of the day, they ended up in compliance, and they're happily ever after. It was a successful story, and it's a great case study. If you have one of these things impacting you, I tried to think of an example that would have many different moving parts, and this is one that I came up with. And if you even have one of these things that can help you be proactive in your state tax planning, I think Tom and I did our job today.
Yeah, and I think, Shane, your example is a great one that is one of our most important takeaways here as we wrap up today. We can't emphasize enough being proactive. Shane was able to come to the rescue in that example and get everything right in the end, but it caused a lot of heartache, a lot of time, a lot of dealing with state agencies, and obviously cost out of their pocket. Whereas if they would have been proactive and had their systems in place up front, that all could have been avoided. So some of our takeaways are the obvious. The state and local tax planning has never been more complex and can expect it to continue to accelerate. It's not going to slow down. Technology is not going to slow down. The need to generate these revenues by the states will continue. So get out in front of it. Don't take that catch me if you can attitude. And our last bullet point, I think, is extremely important. It's what we'll leave you with, is if you are that firm that is looking at a transition soon in the future, your owners are looking to retirement or whatnot, and you're going to be having someone come in and examine your operations to purchase you. Believe me, they are going to look under every stone. Their advisors are going to come in and they're going to want to know, have you filed every place you possibly can? And if not, they're going to calculate a potential liability for you, and that's going to impact your sales price. So if you want to maximize the value of what you've worked so hard over your career to build, again, get that house clean before that. And with that, I think we are right on 3 o'clock. So again, we appreciate all of your time here today. We hope you've taken some tidbits away. As Kaylee noted earlier, please fill out the surveys. That really helps us with our future presentations. And put all your questions in there, and we will be back in touch with you very soon after this event to answer those questions. We certainly would be more than happy to entertain a call or or any other communication with you. When you get the presentation here, our contact information is available. So again, thank you everyone, and have a great day. Bye now.